Welcome everyone. Welcome to the Buying Australian Property While Overseas webinar. We're going to get started. My name is Martin and I'll be the moderator for today's webinar. Today we're going to cover a few things. We'll give a quick introduction of each of our speakers and then we'll move on to the getting a mortgage, property investment, property and tax, and then the Q&A sections. Just some housekeeping. The session will be recorded. Slides will be shared after by the team at AusCham. Please ask your questions in the comments/Q&A section and we'll address this at the end. And let's get started. Again, my name is Martin and Ben and myself are the directors at Odin Mortgage. Ben has been helping Australian expats with pre-approvals and refinancing for the past 5 years and knows non-resident policies inside out, while our firm Odin Mortgages specialises in non-resident mortgages. Next, you have Joe Bell-Johnston, the Managing Director of Rent by Move, a licensed auctioneer, a licensed real estate agent, and most importantly, a licensed buyer's agent, meaning she acts for you and not the developers. I don't think anyone in Hong Kong has more property licenses than her. She also has decades of experience in the buildings industry across Asia and Australia. And last but not least, Anthony Berling, Director of the Less Tax Asia practice. Anthony specialises in helping Aussies minimize their tax obligations and set up efficient tax vehicles, whether it's through the individual, trust or company level. Anthony here has over 25 years of experience and was previously a partner at Sterling Wharton Taylor in Sydney. Now, before I pass on to Ben, I want to highlight that not only are all four of us expats and therefore understand the intricacies of being an expat, but all four of the advisors are actually based in Hong Kong, meaning you can deal with us right here locally and you don't have to deal with someone over the phone in Australia. So with that, I'll pass it over to Ben, who'll talk about the mortgage section.
Thanks, Martin. Good afternoon, everyone, and thank you all for joining. Today, I'm going to be talking about the current lending situation for those of you who are living overseas, what the banks are going to be looking at when assessing your application, things to be aware of, and how to maximize your borrowing capacity. I'll also go through a couple of charts to give you a broader sense of the lending market. And hopefully by the end of this, you'll learn a thing or two about getting an Australian mortgage while overseas. So back in 2015, the Australian banks were still relatively lenient to non-residents, okay? And expats and even foreign nationals were all treated very similar to people living in Australia. And we had the big four Aussie banks, Commonwealth Bank, ANZ, Westpac, and NAB, all come up to Hong Kong and Singapore and had branches here with full lending services. So you could get mortgages up here in Hong Kong. And there wasn't really a need for a non-resident mortgage broking expert because all the banks were pretty much lending to anyone who wanted a loan. And all the banks were giving 80% loan to value ratios. All the investors were on interest-only repayments, maximizing their tax deductions. And that was sort of the environment that we were in 2015 and before. In 2016-17, that's where we saw a lot of regulations being imposed on people living overseas. The foreign nationals were the ones that got impacted the most, so people without Australian passports. And a lot of them were not able to settle on their off-the-plan purchases. Now, Aussie expats, we got caught up in the mix as well, although not as bad. Then the major banks, the ones that came out to Hong Kong and Singapore, they actually left in the following years. And two of them got sold off to Singapore banks. And when I say left, they left as in their entire lending department just no longer. Okay, they're still here around, but I think they're just servicing for wealth and insurance products. So around this time as well, it was actually quite difficult to be a mortgage broker in this space due to the constantly changing credit policies. So every week we had different policies changing from different banks, and it's hard to advise clients accurately, I would say. Fast forward to 2021, credit policies have stabilized, which is great. There's more certainty now in knowing which bank will do what. Having said that, the credit policy is now vary significantly from bank to bank. Okay, and it is now more important than ever to really understand the bank's policies to get your loan approved or to maximize your lending. So I'll talk about what's still available for Aussie expats just from a general perspective. Not all banks do 80% loan to value ratio anymore. Some banks will only do a maximum of 60%, some will do 70%, where some will do 80%, and we have one bank that's still doing up to 90% with lender's mortgage insurance, and that's Commonwealth Bank. Now you compare that with Hong Kong, I think the loan to value ratio is between 50 to 60%. So relative to Australia, in Australia you can still leverage up, which is good. You can go up to 30-year loan term regardless of age. So if you're an 88-year-old auntie, you can still get 30-year loan term, provided you have strong cash flow position. As opposed to, say, in Hong Kong, where they look at your retirement age. So, if your retirement age was 70 and you're 50 years old, that's a maximum of 20-year loan term. I would caveat this by saying that there are a couple of lenders in Australia now that are looking from how Hong Kong is looking at it from a retirement age perspective. So if you are, older, 50 plus, and you want a 30-year loan term, then effectively what you require is an exit strategy, and we'll help you with that, which is just telling the bank how you intend to pay your mortgage once you stop working. There is no early repayment penalties in Australia by law, so you can take a mortgage out today and pay it out tomorrow, and you're not going to get whacked with that 1-2% early repayment penalty like you do in Hong Kong. Okay, all you have to pay is this 300 to 400 Aussie dollar discharge fee, one-time fee. It's like an administration fee. So this slide here shows the a chart of the housing interest rates or mortgage interest rates of outstanding loans currently in Australia. So can I use this mouse here? There's two columns. This one's owner-occupier, and this one's for investor. And there's 4 lines, and the purple line here is people who are paying principal and interest repayments. The yellow line is people who are paying interest-only repayments, so they're just paying the interest, they're not paying down the balance. And actually, back in 2015, there was actually only one line. All right, so regardless of whether you're owner-occupier or investor, regardless of whether you are paying principal and interest or interest-only repayments, it was just one interest rate offered by the bank. And simple. But in 2016 onwards, the banks introduced a 2-tier pricing system. Okay, and I suppose that was just from the regulators and banks to help them control the, their loan book. This example here is very clear, right? So for owner-occupiers, you can see that they're incentivizing you to pay off your loan, which is like the rate is much lower than if you would do interest only, which is much higher because they don't like it if you own your own home, you're not paying it down because the interest is not tax deductible. Whereas with investors, the margin between interest only and principal and interest is much thinner because it's acceptable for investors to be on interest only, have a high loan balance, claim 100% of the interest deduction, do negative gearing. And Anthony, our tax expert, will talk more about this in the later slides. So interest only is still available for Aussie expats at a premium, which is around 0.3% margin. However, principal and interest repayment is still the standard. The majority of our clients are on principal and interest repayment, and simply that's just because of a lower interest rate. At the moment, we can do investment fixed rates from 2.24% and investment variable rates from 2.79%. So it's come down quite a lot. It's quite sharp now. And so if you are an Australian, if you have a mortgage in Australia currently and you are the average Australian investor paying more than 3% on your mortgage at the moment, then definitely come have a chat with us. Our team will sort you out, get you on a lower interest rate, better product, lower fees. Just as an example, if you had a $1 million loan and we were to reduce that by 1%, that's 10,000 interest and savings per annum, and it compounds year after year. So it's quite a lot. I want to talk about what the banks are going to be looking at when they're assessing your application. Okay, actually, there are many, many factors and variables, but it just comes down to 2 main factors, really. And the first one is your deposit, and the second is your income after expenses and tax. So deposit, it's just like how much money you have available for the purchase that you want to make. So this can be funds sitting in your bank account, savings account, liquid assets like shares, or even your relatives, your parents can give you a cash gift, and that's also acceptable. Or equity from existing properties. This one I'll talk more about in the next slide. So a quick example here, if you're buying a $1 million property, you can borrow up to 80% on the property. So, minus 800,000, then you got to pay for stamp duty, government and legal fees. We rounded it up that 5% of the purchase price. So 50,000, that equals, for this example, you need to come up with $250,000 to settle on this purchase. So the bank just wants to see that you have this sitting somewhere in, any of these examples here. If you have any more than 250,000, it doesn't really help your case all that much. So I have clients coming to me all the time saying, hey, I got $2 million. Can I borrow more? But if the case in here is only 250,000, it doesn't really help. I know in some countries like Singapore, you could use your cash assets to help you borrow more, but that's not the case in Australia. So talking about equity, what does this mean? So cashing out equity from your existing property. So for those of you listening who are lucky enough to already have Australian properties, there's a possibility that you can release equity or top up your loan to help you purchase that next property without putting much down of your own cash. So for example, let's say in 2015, you bought a property for $600,000 and you got a loan against that 80%, $480,000 loan. Come 2021, you do a valuation on it and it's grown in value. So, it's grown in value 5% per annum year after year. It's now worth $800,000. And at the same time, you pay down your loan to $400,000. So your loan to value ratio now is 50%. You can see where I'm getting with this because you can top up your loan back up to 80% for the cash out equity. So essentially you can top up your loan, okay? You can take on an extra $240,000. So here, the purchase loan from before $400,000, your second loan now, which is the equity loan, $240,000. Your total loan size now is $640,000, which is 80% of $800,000. So you can use this equity loan to help you purchase that next property. So using the example from before, the $1 million purchase, we know that we needed $250,000. We just took out $240,000 in equity from your existing property, and you only need to come up with $10,000 out from your own pocket, which is great. And actually, this is a very popular strategy, and I think a lot of you already know about this for property investors to grow their property portfolio. And it works amazingly well in a boom market when property prices are just going up year after year. And why wouldn't you leverage, right? But, it comes at its risk. So, and it's really up to you at the end of the day to weigh that up. So coming back to what banks are looking at, the second main factor, which is income. And actually, this one is the most important one out of the two. And if a loan was to get declined, 90% of the time it's going to be because something about the income. And I'm going to be talking about the difference between your typical bank that accepts foreign Aussie expats versus a more lenient bank that accepts expats, and see what that looks like. So the typical standard bank will discount your Hong Kong dollar income, foreign currency income, by 20%. So if someone is earning 100,000 per month base salary, we're only going to be looking at 80,000. And the reason for this is because the banks say for the foreign currency fluctuation, which is fair enough, because if you look at the last several months, the Hong Kong dollar has depreciated significantly over the Aussie dollar, and maybe to the tune of 20% or more. So I'll say that's fair enough. But then here, it doesn't make as much sense, because then they would then apply Australian income tax rates onto that $80,000 income. And this person here now will only be looking at 56,000, so pretty much like half of what we started off with. The reason why the banks are looking at Aussie income tax rates is because I think there's 1 million Australian expats around the world, and living in 100 different countries. And the Australian banks don't have the resources or the desire or want to try to understand all of these different countries' tax systems. So they just apply Aussie tax rates because they know Australia probably has one of the highest tax rates in the world. And so if you pass with Aussie tax rates, you're just going to pass it everywhere else. Coming back to this example, let's say this person spends $30,000 per month on rent, which is quite standard in Hong Kong, and then also has living expenses, daily living expenses of around 18,000 per month, which is 3,000 Aussie dollars. He's left with 8,000 Hong Kong dollars a month disposable income for this mortgage that he wants, and I can tell you that's not a lot. So he can only really borrow 200,000 Aussie dollars. Now, to a lot of people, and to this person in particular, you blow their mind, right? They're like, well, I've never been in a better financial position, earn 100,000 a month. I don't have any debt or liabilities, and they can only borrow 200,000. And that's the reality. So now we come over and compare that to a lenient bank. This is what it would look like. Okay, so a lenient bank would only discount your foreign income anywhere between 0 to 20%. So let's say you can potentially keep 100% of your Hong Kong dollar income from the start. And then they will also allow you to use local Hong Kong income tax rates, which we know like the maximum anyone can pay in Hong Kong is 15%. So this guy, he has 85,000 after deduction. Minus the rent, minus his living expenses, we have 37,000 disposable income, and he can borrow 600,000. So that's a 3x of the other bank that would accept Aussie expats. So obviously this example here is oversimplified. There are many factors that go into play. For example, for you expats are on packages with bonuses or allowances, those are treated differently. Or if you had kids in private school, that's also going to affect your expenses and so forth. But in a true case, and over all the hundreds of applications that we've done, the variance between how much you can borrow can range up to 4 times the amount. And I suppose this is where we come in as the expert mortgage advisors who only deal with Australian expats and foreign national applications. So what we do day in, day out, and it's our bread and butter. So we can tell you exactly how much you can borrow based on your current financial situation, what are your lending options, the rates, the fees, and so forth. And we don't charge a fee because the banks pay us and they all pay the same. So we're just going to take you to whichever is going to be the best for you. So I want to move on to my last slide, which is the cash rate, the Australian cash rate set by the Reserve Bank of Australia. Okay, as you can, currently we're in an all-time record low right now of 0.1%. And the cash rate has been coming down gradually from 2011, okay, and now to 0.1%. Is it going to go lower? I don't think so. I don't think we need to because Australia has performed relatively well compared to the rest of the world. And based on the March monetary policy statement by the Reserve Bank of Australia a couple of weeks ago, the RBA has stated that they will not be increasing the interest rates for the foreseeable future. And two, wage growth and employment growth goes back to what it was pre-COVID. And they don't see that happening until 2024, at the earliest. So that's another 3 years, which is going to be what you're currently seeing here. So we're definitely heading towards an environment of low rates and rising house prices. So there's never been a better time to be a property investor, in my opinion. And on that note, I'm going to be passing it off to Joe Bell, who's going to be talking to you about Australian properties. All right, Joe, take it away.
Thank you, Ben. Welcome, everyone. So this afternoon, we are going to discuss the property market. We're going to do a quick review of market approach in the current market that we have at the moment in Australia. We'll look over some historical mistakes and how they've cost some people quite significantly. We'll talk about why you might work with a buyer's agent, and then I'll finish off today with some case studies. This is a slide that gives you a little bit more about me. I'll leave that with you to have a look later. It's got my qualifications and you're welcome to check that out at another time. So the Australian property market at the moment is booming. It is a broad-based boom and it's the first of its kind since August 2003. Australian housing values rose 2.8% in the 3 months to January, with every capital city and the rest of state region increasing in value. What's driving this boom currently are 3 main factors. Very low interest rates, as Ben has just covered off, improving conditions economically in Australia, and record low stock levels. In the 3 months to January, dwelling values rose in every market segment, with the high end of the market performing in Sydney, Brisbane, Adelaide, and the ACT. When we look at what's going on down there, we see this as a sustained boom, and we don't anticipate it's going to end anytime soon. Another data set that I take seriously and keep a very close eye on is auction clearance rates. And here on this slide, we can see across the capitals what the performance to the end of February looked like. While we have a weighted average of 79.28 across the country, we look to areas such as Brisbane, the 3rd largest city across our major cities, and the last city really to embrace an auction method of sale. We're seeing mid to high 70 clearance rates in Brizzy. And we're also noticing that as we go past the end of February and coming into March performance, we're seeing them trend up. When we look to Sydney, Adelaide, Hobart and the ACT, they're all tracking at the moment, Brisbane, Adelaide, Hobart and the ACT, they're all tracking at record levels. So anyone interested in these markets, take note. Okay, moving on to a forecast now. I'd like to look at what is ahead for 2021-22. In this slide, you'll note that the forecast for 21 and 22 sits at 10% growth. Well, I'm looking up and down the east coast of Australia for clients I'm searching for right now. And in some pockets, I'm noticing 1 year growth rates above 20%. So in my view, this is an extra conservative view. And in my opinion, I think what we're going to see, particularly in Brisbane and regional Queensland, growth rates that over the next 2 years will hit 40+%. Now, whilst we've got this conservative view across Australia of 10%, I think we're going to land somewhere between 15 and 20 when we look at the national view. Moving on to new listings. New listings are an issue, and that issue is driving demand, which is creating in part what we're seeing in Australia. In this slide, we're looking at the rolling 28-day count of new listings across the nation. And what we're seeing here is a data set that's still showing us almost 13% below the 5-year average seen at this time of year. When we then go to the overall stock levels, what we're seeing here is stock levels approximately 100,000 properties below what we would look to see on the 5-year average at this time of year. Moving on to trends. From where we've been observing our market activity, these trends are emerging and they're quite interesting. So we're seeing a lot of lifestyle changes coming into the market. So people moving to the coast or people looking for that tree change. Now with that, I think some of those lifestyle changes will head back into the cities, but a portion will stay. First home buyers are an active market segment. They represent about 50% of the market activity. However, the Home Builders Grant will end at the end of this month. And with that will come a drop off with the first home buyers. We are seeing low vacancy rates when we are looking at rental property. Now, what is driving this? This low vacancy equals an increase in rent prices, which equals an increase in property values. So if your goal is to be an investor, my tip for you today is to keep a watch on low vacancy areas, and the correlation of growth sits right there for you. The impact of infrastructure is having a direct impact on price values going up in the residential sector. So where we see large infrastructure projects, we're also seeing a sudden rise in price, and we're seeing an increased activity from the buyer side. When we look at our next set of trends, we're noticing the return of the expat. So my audience today are buying en masse and going back to Australia in 3 different ways. There's the investor, which is something we're looking for back in Australia. We're also seeing that family that are looking to return back to Australia in a couple of years' time, and they're buying their return home. And then there's a group of expats who are going home to sit COVID out because they've got aging parents or they've got children in boarding school. This return of the expat is also feeding into the prestige property market, which is very hot at the moment, and in fact is driving the Sydney market particularly. Working from home requirements are now a big aspect of people's search criteria, as is upgrading and improving. In the past, we may have seen people move more towards renovating a home when they wanted to upgrade, but now we've got equity, money's cheap, now's the time to buy, so it's simply a case of listing the house and moving on to improve. The commute from work is definitely less of an issue at the moment, but as the big corporates in Australia ramp back up, I don't know that they're going to be too happy to have their workforce working remotely 100% of the time, so that may temper out. And we are happy to see the investor returning back into the market. If we have a look at all property across Australia, the makeup of homeowner to landlord is 70-30. So only 30% of property in Australia is actually landlord owned. And as we look at the affordable entry price of property squeezing out, we will start to see increased demand for rentals. So Sydney and Melbourne are lagging in this space at the moment, but once our borders open down in Australia, in Sydney and Melbourne particularly, migration and the return to work will start to change that landscape. On rental markets, what we're looking at in this slide are the rental rates. So what we've seen coming into January is a 2.5% increase across the year to January across the country. But if we hone in on some of those areas on the right-hand side of screen, what we'll see are some outstanding performance areas. So places like Perth and Darwin, where we're really seeing increased rates. And that is all down to the supply and demand circumstances. In the next slide, what we're looking at here are yields. Now, across Australia, we noticed that yields have fallen and they're at a 3.69% rate at the moment. However, what we are seeing is a slight trend up. So we will take notice of this particular page over the next 6 months to see where this adjusts to. However, keeping in mind, entry prices in this market, it's booming. The prices are only going to continue to go up. So we need to be very careful when we're looking at investments where those opportunities sit to get the best yields. And that's something I can elaborate on further for you at an individual level. Okay, so now I want to talk to you about how to go about approaching a market like we have in Australia at the moment to be able to buy the property you're looking to buy. This first point of understand the market is combined also with having a plan. So when you go to purchase a property, the most important part of starting out is understanding why you're buying that property. And at the same time, then understand the market in which you're looking to buy that property in. There are different challenges, and certainly one of the biggest challenges ahead of you there at the moment is competition. So to Ben's point earlier, finance is a major aspect to getting a property that you're after, and it strengthens your negotiating position. At the moment, ladies and gentlemen, what we're finding in Australia is unconditional contracts are winning over the price at the moment. So a vendor wants to lock and secure that sale in. They're not keen to have finance subject to finance and subject to delayed settlements. It really is an important aspect. Do your research. Be very thorough about what you're buying and where you're buying it. But more importantly, in this market we're in at the moment, is understand what is a fair market price for what you're looking to purchase. So whether you take this project on yourself, or if you're going to be working with a buyer's agent, these are my tips to keep you ahead of the game. Your research really is a very important aspect of the overall success. Study your micro and macro economics, understanding what is happening within the property type and profile you're buying, and then at the same time, understand what's going on around the environment that the home is sitting in. Look at both the short and the long-term impacts. That means, how does this property serve your plan now and into the future? Future-proof is a word we throw around quite loosely, I feel, but in this context, I would look at areas of high expense when I'm buying a property for a client. So for me, it's kitchens and bathrooms. What do they look like today? What investment might be required in those spaces over the next 5 to 10 years? And is that going to then make sense to purchase this particular property if we have to invest a certain amount of money into it? Conversely, looking at what's happening from an amenities perspective, what will happen in that area, and understanding the future projects so that you are protecting what you're buying now. My last point on this page is one I say with great respect to the adjacent industries that I work in. There are lots of people who claim to have great advice on property. Don't listen to unqualified noise. You don't go to a dentist to get a broken arm set. So make sure that if you're wanting to take advice on property, you seek out the advice of experts. In the past here in Hong Kong, we've had seminars and presentations held in hotels that have been marketed through agents based here in Hong Kong. These seminars are being conducted by developers and builders who are selling what we call off-plan property. Now, off-plan property represents quite a few challenges in and of itself, but mostly there is no negotiating on off-plan property. There's a set price, you pay that price, and as a consequence of how it comes together through the agents that have marketed up here to get the audience in, there are layers and layers of commissions that are applied. In this circumstance, I've put 20 to 40,000, but in fact, folks, I've seen amounts up to 100,000, and that has a crazy impact when the time comes to go and sell that property down the line. The distance between signing a contract and getting a property built in the new build area can blow out to 5-6 years. In that circumstance, what you're finding is a market shift potentially in that time. And that will change and alter your position. It'll change and alter the nature of the product that you end up with. And also, when you live up here or outside of Australia, the support at completion when properties get handed over. Now, in Australia, we've seen unprecedented levels of defect issues within unit buildings particularly. And when we look at handovers and the defects that sit at the handover stage that are never rectified because offshore investors or expats are investing, there's no one there driving the conclusion of the make good of those defects. So that can lead also into property management. I'm a landlord and I'm in the industry clearly, but I've experienced both the good and the bad of property managers. And let me tell you, when property isn't managed well, it does result in damage. And then you end up, you're looking at what you've got and you're sometimes in a situation where your current value is below what you invested initially. So these are some of the things just to be mindful of and to steer clear of in the future. Now, as a buyer's agent, I have a process and I'm going to walk you through my process, but buyer's agents at large will have their own way of doing things. I start with a consultation. At this phase, it's an opportunity for both parties to decide whether or not it's a good fit and if working together will result in an outcome we're looking for. Once my client has agreed to use my services, we sign an agreement and I take a brief. That briefing document becomes my true north. Everything I do reverts back to the briefing document, and I have to make sure that when I'm in my research and due diligence stage, which comes next, everything that I am positioning for my client to review meets that brief. When I do provide them with a shortlist, and I represent professional athletes and very busy C-suite executives. These are people who don't have time to be getting lists and lists of properties to review. So the idea of a brief means I make sure everything that's on that brief is in that shortlist, otherwise it doesn't make the shortlist. We then do site visits, which I do very effectively from here in Hong Kong. I'm able to do virtual visits and I find that they're actually a great way of getting into the property because I'm doing it one-on-one with the agent. Then once we've selected a property, we go into negotiations. As we were discussing earlier, I am an accredited auctioneer. So that means if it's an auction bid, I'm in the best position to be able to run that auction as a bidder from a remote location. It's interesting how you can temper the tempo of an auction when you're on the phone. And when you have a deep understanding of the auction process and the theatre that surrounds it, you're in much better control as a negotiator. Once we've secured the property, we move into contracts. This is quite a tricky phase for a lot of people and requires a lot of support and understanding. Contracts and special conditions can mean pain or ecstasy, however you want to look at it. But my job is to make sure that all the contract conditions that are included in your contract as a buyer are safe and sound and suit what you are looking to achieve. We then go into handover, and this is an important phase. A lot of buyers agents back out of the service offer once the contract is signed and is exchanged and unconditional. I stay with my clients through handover, and I have a unique business model. I also offer international support. So if you are a returning Australian going back to Australia and you're buying property, I give a complimentary relocation support service as well. Now, I just want to run you through a couple of case studies so you get a feel for what a buyer's agent can do for you. In this case, I was buying a property in Frankston, Victoria. My client was on a very tight budget in a booming market. She was a rather indecisive, risk-averse client, and she hadn't got her finance approved yet. That meant she wanted me moving, but I was unable to really secure anything for her because we're in this state of no finance. So I got that sorted out for her. We finally found a house that she really loved, and it went on the market within 2 days. 54 people had been through, 13 offers were received, and my offer was the third highest offer. Through carefully negotiating the terms and conditions in the contract, I ended up being able to secure a price with no conditions other than a 2-day cooling off period. The cooling off period allowed me then to get a pest and building report done very fast through my network, and also a conveyancer checking the contract again through my network. The building and pest report identified a roof issue, and I was able to go back and renegotiate the terms of the agreed price, which resulted in a further reduction of $10,000. Now, the result on this property, my client paid $570,000 instead of $585,000. So I saved her $15,000 there. We saved $300 on the conveyancing and $250 on the building and pest report. My buyer's agent fee on this particular acquisition was $9,975, including GST. On my next case study, we moved to Adelaide. My client was a professional basketball player and his partner. They were first home buyers moving from one state to another. They wanted to leverage the government grants in place, and the builder's grant, which meant for new property, was actually coming off in December 2020. It's since been extended, but we could only work with what we knew at the time. I had to be quick. And also my clients didn't want to be stuck in a rental for too long. So really needed to find something that had started the construction process and was only roughly 6 months away from being completed. They wanted 3 or 4 bedrooms, 2 bathrooms. Their long-term plan for this property was that it would become a rental. So I needed to look at what would suit them now, and I needed to look at what would carry through as an investment into the future. Now, coming into Adelaide, there are a lot of new developers, not just in Adelaide, right across the country. And there are a lot of developers with no track record or history. And as I mentioned earlier, there's lots of defects that exist in developed managed estates. So I did my due diligence. I uncovered a developer that had been developing in the Adelaide marketplace for more than 20 years, and that the bulk of their developments had been done using cash. So their equity was very solid, and I knew that the product was high quality. The result for this client, we found a property that was 3 bedrooms with a study, 2 bathrooms, a townhouse, but on Torrens title, in a very tightly managed estate with very low holding costs. In a premium location, 4 kilometres from the CBD of Adelaide. We exchanged contracts before the December cutoff. I negotiated $18,000 in extras for this client, getting floor coverings, bench top upgrades, window coverings, additional electrical on the floor plan, and also reverse cycle air conditioning. My client secured the $30,000 government grants, and the value since they've exchanged on that contract, and they'll settle next month, that property has grown to 2.5% already for them. My buyer's fee on this one was $7,063, including GST. Now, when you buy a property in Australia, there are tax implications as a non-resident. I'm going to pass over now to Anthony to run you through those.
Excellent. Thanks, Joe. I'll just take over control of the slides here and we can get moving. Thanks for bearing with us. I'm now going to talk about tax, which everybody loves. So we'll just move on. If you can just pay attention for a little bit, we'll go through some tax laws, some rules, and some good ideas that can save you a lot of money. So once you buy your rental property in Australia, you have some tax obligations. You must lodge a tax return, and you should do that every year. But just because you need to lodge a tax return, this does not mean that you need to pay tax on that investment property. If you do it right, you can get your money tax-free. So quick background into the Australian tax rates. This slide can be a little bit scary for people who are not familiar with the way Australia works. You can see here the tax rates get very high. If you first $18,000 for residents free, but then everybody after that 19%. So you're already at a higher rate than what you're used to in Hong Kong. All the way up to 45% for the residents and the non-residents. As a non-resident or an expat like us, you'd get hit even worse. The very first dollar you earn, the ATO wants 32.5% of it right from the start. And that's not great. And you can see up here as well, all the way up to 45 once you're earning over 180. Now, as a non-resident, it's unlikely you're going to make $180,000 a year on rent, but when you sell that property, you could end up in that high tax bracket. And we'll talk about some ways to make sure that reduce that tax as much as possible. These rates as well are not the actual rates that you pay. If you're a resident, you'll pay a 2% Medicare levy on top of all these and potentially a surcharge, or you may get some adjustments for the low income tax offset and the middle income tax offset. None of that should affect the non-residents. So those marginal tax rates are applied to the income tax as you'd expect. That's your ongoing rental income reduced by your deductions. But they also apply to the capital gains you make. So even though we use the term capital gains tax a lot, there's no actual capital gains tax rate. What happens is you make a profit or gain on your sale, and then it goes back into those marginal rates that we just saw on the last slide. So capital gains have a couple of things that you may be able to do to reduce them. You can get a discount if you've held it for over 12 months, or you can get the main residence exemption if you lived in it. The rules around those are a little bit complicated, especially for non-residents. So here's a simple example that we can walk through and see how the whole thing can work. This is based on buying a unit in Queensland for around 600K, taking out a loan of 480K. Now, all these figures come from slides, which you can see at the end. You'll get in a printout. They've been generated from the Odin Mortgage guys. So if you need to, you can go onto their website and plug in your own figures and come out with this sort of result. So you got your rent, 5% yield, $30,000 a year. Nice. After that, your agent's fees, your strata rates, your insurance, everything, 7 and a bit, and then the interest on your loan. You've come up with a net result of $9,128 cash at the end of the year that you get to keep. And this is where things get nice. You can have non-cash expenses. Building allowance, which is a depreciation on the construction cost of the building, and capital allowance, which is depreciation of your fit out inside the building. Now, the trick is with the building allowance, it's not depreciation on what you pay for it, it's depreciation on how much it costs to build that building. So you're not, unfortunately, if you buy $1 million place or a $600,000 place, you're not getting depreciation on a full 600,000, but you still get a good result. $6,000 tax deduction for no cash, another $3,000 for no cash, and with a tax loss, $404. Positive cash flow, no taxes payable to the ATO. That $404 loss or any loss can be carried forward indefinitely. It can be used to offset future rental profits. It can be offset your capital gain. Or if you move back to Australia, it can offset your salaries income. The politicians were talking about changing that at the last election, but at the moment, that seems to have gone right off the the focus. They've got a lot of other things to worry about. So hopefully those rules will stay in place for a long time yet to come. The party that did take the idea to the last election that would be taken away, lost. So even they think it's not a good idea anymore. Now, if you run that scenario and you just can't quite get down to the loss, there's other things not to do with your rental property that you might be able to use to reduce the tax. Depending on your income protection insurance, you can get a deduction for that against your Australian rental income. Your donations to Australian charities, unfortunately, donations to charities in Hong Kong or outside Australia won't count. And you can also make super contributions. There's been a lot of changes to superannuation in the last 2, 3, 4 years. So it's a lot easier for people to get deductions and to get larger deductions by making superannuation contributions. There's a few caps on how much you can put in. There's some age restrictions. If you're pushing up towards 70, 65 to 70, you might want to look into those. We can talk about those afterwards if you like. Now, the next problem that you might have with your sale is your capital gains. Capital gains is pretty simple. It's your sale price less all the costs involved in owning that property for all the time you've owned it. So that would be the purchase price, the purchase cost, which would be your stamp duty, your inspection, your buyer's agents, your legals, so they all become deductions. Your sale costs, which would be your agent's fees, your advertising, once again, your conveyancing and all that sort of stuff, all comes off. And if you didn't rent it, you can claim all the stuff that somebody who did rent it could get. So now you can claim your interest, you can claim your repairs and maintenance, you can claim your land tax, your insurance, your rates. That comes in if you lived in it or if your family was living in it and you weren't renting it. So if you sent the kids over to live in the property while they went to school or uni, that's when this really comes in handy. And a lot of people miss that when they go to sell their property. They think, oh, I didn't rent it, I can't claim the interest. Not true. So once again on capital gains, the ATO has a nice rule where if you own it for 12 months, you get a 50% discount. So if you've made $100,000 profit, or gain, sorry, you would only get taxed on $50,000. And that's really nice, unless you're non-resident. From May 2012, they changed the rules on that for us. And now you might get none, you might get up to 50%, you might get 25%, but you need to do a calculation to work it out. But you will not get 50%. And that works whether you bought the property while you're a non-resident and went back, or whether you owned it and left, or whether you did either, went back and left again, or stayed there. The other one is a main residence exemption. And this is really nice as well. If you live in it, you don't pay tax when you sell it. Really simple and really good. If people had to pay tax when they sell their family home, nobody would ever move. You would never be able to afford a property as good as the one you just sold. You've probably heard of the 6-year rule. If you move out of the property, it can stay as your main residence for 6 years. And during that time, you can sell it tax-free, or after that time, those 6 years will still reduce the amount of tax payable, unless, of course, you're a non-resident. They changed the rules very recently on that. So when a non-resident sells their house or their home, there's no main residence exemption at all. If you owned it for 20 years, lived in it for 19 and then sold it, you would pay tax on the entire gain. So a quick, simple rule there, don't sell your home when you're overseas. So there's a few other things with capital gains. As we mentioned before, there's no capital gains tax rate. So your gains are added to your other income. So when you're a resident, if you've got a salary and you're doing quite nicely, earning 180 grand a year, you sell your property, the government's going to take 45% plus Medicare levy of the gain you make on the sale. Any capital losses you've got, you can use to reduce the gain. So that might be shares that are in a loss position, you might want to sell those, or if you've got one property doing well and one property doing poorly, sell them in the same year. And conversely, if you've got two properties doing well, sell them in different years. And there's also 12.5% withholding on sales over $750,000 by a foreign resident. So if you're overseas when you sell your investment property and it's over $750,000 at settlement, the ATO will take 12.5% and you won't see that money again until you lodge your tax return. You can vary that down if you've got a good tax agent and a good record. And that can be a big difference, especially if you are looking to use the money you get from selling your house to buy something new. All of a sudden, you've got 12.5% less cash than you thought you would have. And that can make a big difference trying to find the deposit, as Ben mentioned earlier before. So here's a capital gains tax example. Using our same unit at a moderate growth rate of just 6% over 5 years, as you noticed from the slides that Joe produced, 6% is a very conservative estimate. You're going to get just over 800,000. Cost base, after we add in all those extra expenses, 620. Depreciation you've claimed gets added back, and you come up with a gain of 226,595. If you're a non-resident, the net gain that goes into your tax return at marginal rates, 224. If you're a resident, much less, 111. If sometime during the 5 years you move back to Australia, your figure will land somewhere in between these two numbers. Once again, a bit of a complicated calculation to work it out, but that's the worst case, that's the best case. So, tax payable, this is what you want to know, right? Based on that profit, if you're a tax payable for a non-resident and you own it yourself, 81,500. If you own it together with your partner, only 61,500. Just by making the right decision when you bought the property, structuring it very simply to own it together, $20,000 extra in your pocket after tax. Very nice. Now, also, as we mentioned earlier, there's other deductions that can be used to reduce your taxable income for the year you make that sale. Even putting aside selling the shares to reduce the property, to create capital losses. For example, if you made super contributions of $125,000 during that year for each taxpayer, for sole owner, your tax has been reduced down to $32,000. So that's a drop from 81 to 32. It's pretty good, almost 50 grand in your pocket. If you're joint owners, when you sell that property, you will pay no tax, no capital gains tax on the sale of that property. Quite nice. So that's how it works. When you do it right, you set it up correctly, you get your rental income, 9K a year. So for this example, 5 years, 45K. Make your cash profit on sale, 180K, total cash generated, 225K, income tax paid, nil, which is a great result in any country. In Australia, even better. So that's how tax works with rental properties in Australia. We've got a couple of extra slides here at the bottom, which you can get later, which are all the figures that we use to generate those examples from the Odin guys. And I will pass it back to Martin.
Thanks, Anthony. So that concludes the end of the tax session. Before we go into the Q&A, I'll go over some of the key takeaways. But if you have any questions, please put them in the Q&A box now, and we'll try our best to answer as much of them as we can. So from the mortgage side, get a free pre-approval. That's undoubtedly the best thing you can do if you're looking at property. Helps you with negotiation as well. 80% is still on the table, but you have to go to the right banks. So come speak with us. Low rates should be here to stay. Now, from the property side, the market is still very hot. Research is the way to do it, and ditch the layers, speak to an expert, make your money work for you. In terms of tax, you can make a profit and pay no tax. There are different rules for non-residents, and it's complicated, so get help. And that wraps up the key takeaways, and now we will move to the Q&A. So I think the first question will be for Joe Bell, the $1 million question, which is, how long will this boom last, and what cities are the best to invest in?
Yeah, thank you, Martin. That's a great question. The best cities are always the big cities because longer term they have more they've got a bigger chance of sustaining. But when we look at cities like Perth and like Darwin, for example, they're affordable cities. So as these cities become less and less affordable, people are going to continue to move out to more affordable locations. So my tip in this space is to say to you, this boom's not going away anytime soon. I anticipate it'll be around for another couple of years, at least 3 possibly. And in that time, property is going to jump significantly. And in the areas where there are opportunities, you're going to see growths that are going to be crazy. So my point would be, look for areas where there's low vacancy. Low vacancy means an increase in vacancy rates and an increase in rent values, in property prices, my apologies.
Yeah. And do you specialize in any areas in Melbourne? Or
no, I'm actually across Australia, Martin. So I've currently got clients buying from Adelaide, Melbourne, Sydney and Brisbane right now, with a client that I'm meeting on Friday to talk about Perth.
Okay, great. Next question is for Ben. If you're considering buying off the property, how long in advance should we arrange a mortgage before property completion?
Right, I think it's considering buying off the plan property. All right, so yeah, with off the plan properties, they're not usually selling for 1 or 2 years once you sign a contract. Ideally, you want to come speak with us or start thinking about arranging a mortgage at least 3 months before the completion of that property. And while starting the actual mortgage application only takes 1 month to really get the approval and the loan documents sent out, you want to start the process 3 months early, because there's probably a lot of things that we can pick up from your financial situation that we can assist you with to help you prepare in advance. So when you do lodge that application, it's going to get approved, no questions asked. So yeah, 3 months is plenty of time to do the preparation, and it's what we recommend.
Yeah. Mm-hmm. And what are these lenient banks you mentioned with the lower sensitization of Hong Kong income?
Yeah, I think I already typed the questions out on the answers on this one already. But the lenient banks that don't apply Aussie tax rates are St. George Bank, Heritage, Bank West, Bank of Queensland, and Kudos, especially for people in Singapore. So I wanted to say that we would go with lenient banks if servicing was an issue. So if, based on your financial position and your income, we were not able to get that borrowing capacity that you needed, then obviously we'll look at lenient banks, and that can help you. But if you had high income and really no expenses or liabilities at all, then we would look at actually the harsher banks. And sometimes those harsher banks might actually be the better banks, like ANZ, CBA, some of the harshest banks, but they will lend up to 80%. And obviously they have the best online banking platform, most branches in Australia, even though that's kind of useless for Aussie expats. There are certain things whereby it makes more sense to go with a harsher bank, case by case. It really depends on the individual circumstances.
One for you, Anthony. You can also read it in the open section if you want to read the text. But tax, it seems more optimal to buy joint with my wife than solely. What if my wife isn't an Australian passport holder? What are the impacts? Is it better to buy in joint name or sole?
Okay, well, tax works on residency, which has very little to do with the Australian passport holders. So it doesn't matter if she holds an Australian passport or not, and there'll be no disadvantages to her not having one or you having one in terms of income tax and capital gains.
Yeah.
Whether it's better to buy the rental property in joint or sole, if it's purely investment and you're going to stay an expat or a non-resident the whole time, then from the example we ran, it's definitely better to buy in joint names. If you're going to go back to Australia at any time and one of you earns substantially more money than the other, it might be better to buy it in one person's name where they can take advantage of the negative period.
Okay, another one. If I buy a home while non-resident and then move back to Australia to live in it, can I claim the primary residence exemption for CGT purposes?
Only from the time you move back, not from the time you were living overseas. So once you sell it, there'll be another calculation and the gain will be apportioned. So apportioned was your residence, no tax.
So one final question, we'll probably have to wrap this up, but it's for Joe. Just bear in mind that we will answer these questions and we'll send them out via an email on OzCham. Slides will be shared and the webinar is also recorded. So Joe, last question for you. I keep seeing articles saying apartments in Australia are in trouble, but I don't think I could get enough money for land, a landed property. Is there any upside on bigger city apartments?
Thank you for that question. Look, I think it depends on what you're chasing. If you're looking for yield, apartments are great on yield, depending on the location in which big city. So I say to my clients, if you're going to buy an apartment, buy it in Sydney and only select certain pockets in Sydney. And lastly, where there's a lot of product or a lot of stock that's very similar, look for something in that apartment that you buy that's unique. It might be a backyard area where other apartments don't have that. It might be a triple garage. It might have an aspect with a large balcony, but it's got to be different from the pack, and that'll put you in good stead. Again, if you pick the right pocket, eastern suburbs of Sydney is a great location, and at the moment representing some good opportunity. So that would be my tip in that way.
All right, thank you everyone. That's all we have time for today. As mentioned, all the advisors are based in Hong Kong, so feel free to grab a coffee with us or give us a call, anything you like. All right, thank you everyone.
Thanks.
Bye.